revealing my two highest conviction stocks going into 2026. And my favorite part about them is both of them are flat in 2025. And I love whenever a stock is flat while the fundamentals are improving. Maybe the stock was overvalued, maybe there was another reason, but the fundamentals are getting better, the stock is not moving. And to me, this is like a spring that's waiting to explode higher anytime. I believe both of those stocks could potentially explode higher in 2026, and I'm gonna tell you why. If you do enjoy it, please press the like button and let me know what you think in the comments. The first one is Amazon. Amazon has been terrible this year. It has lagged behind every single big tech company. Even old school Apple is outperforming Amazon. Microsoft's up 17%. Google is up 67%. Nvidia 38%. And Amazon is barely up 3.8%. And you don't even have a dividend to get anything. At least Meta has a 0.3% dividend and Amazon has nothing, you know. So it's been frustrating to hold Amazon, especially for the last 2 years, mainly 3 years. It has really underperformed. But I believe this time is different, and I'm going to tell you why. Now, there's a lot of things that have happened in 2025 that have gone under the radar. And if you look at the stock price, you believe that nothing has happened in 2025, but the opposite is true. One thing that has happened is Amazon continues to improve their efficiencies in general. Their gross profit margins has increased from 22% to almost 50%, and it has improved about 2 percentage points year over year. And this is largely due to their robotics operation. Amazon has one of the best robotic systems and technologies in the entire world, and none of it is priced in the stock. Not just in terms of the efficiencies that are coming from those robotic operations, but from the long-term potential of licensing this technology to maybe some warehouse companies, some retail-related companies, and just warehouses in general and distribution centers. This could be like another AWS business for Amazon, where they collect recurring revenue for providing robotics technology and software in general, and they can easily do it. But even for their own operations alone, the efficiencies are huge, and none of it is priced in, with the company planning to automate 75% of their entire operations. This is really amazing. Something else that has happened in 2025 is AWS is re-accelerating again in terms of growth. From 16%, 17%, last quarter it was 20%. This is really amazing. Now, if you look at Microsoft Azure, it's been rapidly growing. AWS has been lagging behind Azure. But the secret to Azure's growth was their partnership with OpenAI, and they're using a lot of compute, and that has massively benefited Microsoft. Now, AWS or Amazon, they don't have an OpenAI partnership, but they have a stake in a company called Anthropic. And Anthropic has been leading on the API segment of AI. And this is why Amazon Web Services revenue is massively re-accelerating to 21%, and it's expected to increase from there as they rolled out a second facility. And that's really going to accelerate the company's growth in general. And I'm very, very excited. Now, something else that has happened in 2025 is Amazon has rolled out their latest AI chip to compete directly with Google and Nvidia. I believe a lot of good things will come from it. They are launching a 30-minute delivery in Seattle and Philadelphia, and this is mainly for household essential items. And if you really think about it, the main reason why a lot of people go to Walmart is because they want something quickly. They don't want to wait a day or 2 days for Amazon to deliver the stuff. Or this is why a lot of people, they use Uber Eats to even order, let's say, something from Walmart or Instacart or whatever it is. Now, if Amazon can deliver all those things to your door in 30 minutes or within an hour or even 2 hours, would you really gonna go to Walmart as often as you would go? Or would you even go to maybe, I don't know, Dollar General or Dollar Tree or whatever, if you can get it in 30 minutes with Amazon? Now, this is a long-term plan, but I believe it's available in the Middle East and it's available in other places, and it could potentially be available in the United States. And you're talking about a disruptor, and it's even going to disrupt, in my opinion, Walmart, Instacart, and a lot of those, and even Dollar General, Dollar Tree, and a lot of those, you could say, even convenience stores, and a lot of just places where, why would you go if you could sit at home and get it in 30 minutes or an hour? This is a massive, massive change, and Amazon is benefiting from it. And they're also rolling out a lot of things within drone delivery, and I can go on, and space stuff and satellites, and it really never ends with the kind of exposures that you're getting with Amazon. And this is why I love the company very much, is because they don't pay a dividend. They don't do buybacks. I always love a company that is finding a place to reinvest in itself. If they believe they can get a higher return reinvesting in themselves than giving it to me as a shareholder, I would much rather the company reinvest in itself, which is why I call Amazon, it's like a mega cap startup. Maybe that's not the best name for it, but they just don't do buybacks, they don't do dividends. They get 130 billion in cash from operations, 120 billion goes in capex. They just keep reinvesting in themselves, buying real estate, building up the moat, and just getting a better competitive advantage. And I really love that for Amazon, and I really love holding it. And one thing, for example, they were able to do is they were able to expand Amazon Logistics to 28% of total US parcel volume, and they're about to take USPS, overtake USPS within maybe 1 or 2 or even 3 years. So we're talking about a physical mode that AI cannot disrupt and nothing can disrupt it. And I love that very much. And in terms of all those things that you're getting, you're only paying 14 times operating cash flow. 14 times is very cheap for a company that's growing 15% and expected to continue growing operating cash flow up to 21%, 21%, 20%. So you're paying less than 1 time the growth for an amazing wide mode company like Amazon. And I look at the chart, how it has underperformed. And I look at last year, how Google was kind of underperforming and it outperformed this year. And the year before that was Meta. And it's like every single year we have a different stock. And I believe next year it's highly likely that it's going to be Amazon. It's way overdue. I think it's going to happen. This is a large percentage of my portfolio, and I'm planning to buy more of the stock. So I love it for 2026, and I love it even more for the very long term. Now, the second stock, which I talked about recently, I'm going to talk about it again, is BAM, which is Brookfield Asset Management. I'm not going to do a deep dive on the stock because I did it in this video. I talked about it, and I also talked about Mama stock, which is up like 30% today, and it's doing really, really well on earnings. But for BAM, there's a wide gap between BAM and BN. And the gap, since I did the video, has been closing, where BAM is outperforming BM over the last 5 days and over the last months even. So maybe some investors are starting to realize the value. And as I said in my prior video, I don't believe the gap is going to last for very, very long. But even if you look at a longer term chart, BAM has always outperformed BN on an adjusted dividend. So if you adjust the dividends on the chart, you can click and adjust it. BAM has outperformed BN, but recently BN has outperformed BAM. And as I said, I don't believe that's really going to last for very, very long. But I believe 2026 is going to be an amazing year for the company. And the companies are saying it themselves. They said we very much expect 2026 to exceed the levels we have achieved in 2025. But Brookfield Asset Management is an asset management company. They manage over 1.1 trillion of assets. And by the way, I'm using Fiscal.ai to come up with all those charts and all those just amazing charts. And if you want to try it out, they give you 2 weeks of free access if you use my link into the description. But Brookfield Asset Management is an asset management company, and they get the money from a lot of endowment funds, a lot of sovereign wealth funds, a lot of just in many insurance companies and many different institutions. And they invested in infrastructure, in renewable power and transition, mostly outside the United States because that's not too popular here in the US, private credit, or private equity, I should say, real estate, and credit in general. Credit is a large percentage of the portfolio. And I'm going to go through some of the risks and some of the comments that I got in my latest video. But in terms of BAM, my favorite part about it is that it's integrated within Brookfield, and most of it is owned by Brookfield. So because it's owned within the Brookfield ecosystem, 87% of the capital is long-term. So most of their capital is either locked in through 10-year contracts, or it's BM's own money, or it's the Brookfield insurance business where they invest the annuities and they make, kind of a risk-free rate on that. And it's easy money, I would say, or I shouldn't call it easy money, but it's pretty straightforward. And most of it is really long-term. So if we have a financial crisis or we have another 2008 or whatever, those kind of funds, they can't just call BAM and say, hey, we want our money, we want to redeem our interest. They can't do that because they're locked into very long-term contracts. The company is really amazing. They have a higher net income margins than Visa, than MasterCard, than Google, than Nvidia, than most of the tech stocks that you love. Their net income margin is 50, 8%. This is one of the easiest business models to value or even to analyze, or even the income statement. I would say a 5 or 10-year-old can read the income statement, and it's pretty straightforward. They have the revenues, which they mostly collect from management fees for managing the capital. Then they collect something called carried interest, which is a performance fee. So let's say, for example, their infrastructure fund has a target of returning 10% per year. Okay, if they exceed it and they return 12%, they get a portion of the upside above the 10% targeted return. It's called carried interest. They get 1.2 billion in revenues. They have some compensation to the managers and very basic administrative expenses and a few other things. The total expenses is 515. Then they have something within taxes and just very basic things, and end up with 724. I mean, you could go look at the income statement. I don't want to waste your time, but it's very straightforward. It's a much easier business to analyze than BN itself. And the best way I can explain the advantage of owning Brookfield Asset Management is here in this paragraph, where one of the Brookfield companies, which is called Brookfield Wealth Solutions, it's an insurance company, they acquired another company called Just Group. Okay, Just Group has about $36 billion of assets. It will be added to the portfolio. While BAM is not contributing capital to the transaction or taking on any insurance liabilities, we will become the investment manager for a significant portion of this portfolio. So this is the best part about owning BAM, is you're not taking on the insurance liabilities. You're not taking on the real estate debt that's being involved in a lot of those deals. You're not taking on some credit risks even. You're not taking really those things on, because you own the investment management company. They invest the money, they collect the fees, they get it, they pay 90 to 95% as a dividend, and the rest they just reinvested in themselves. It's very straightforward, high margin business. And this is another example where they recently signed a $20 billion for an AI infrastructure project in Qatar, where the company will build it out and will manage it, and Qatar is putting the 20 billion, and BAM will collect their fees for managing the money and returning a good return for Qatar. So this is how simple the business model is. Now for 2030, they expect to double their FRE, which is their fee-related earnings, from 560 billion to almost 1.2 trillion dollars. But the company should really be valued on DE per share, which is their distributable earnings per share. It's like an adjusted metric, but it's not really too far from the current net income. It's nothing really too crazy, but they expect to grow DE per share 18% CAGR between 2025 and 2030. And now they're doing a lot of M&A. And because of that, they expect to potentially exceed 20% annualized earnings growth. So they're guiding 18 to 20% of distributable earnings per share. I don't have a DE per share chart on a valuation basis, but I have a forward PE ratio. The forward PE right now is at 31 times earnings. And people believe that 31 times is overvalued. I personally don't believe it's overvalued, especially around 28, 29. It's really not overvalued at all, taking into consideration the nature of the business, that the business has no debt. If you look at BN's enterprise value, it's much larger than its market cap. So that's why I like to value them on an enterprise value basis. BAM has no debt, pretty much very little debt. They have a very simple business model to understand. They don't have a conglomerate discount. So BN will always have a conglomerate discount. BAM is a straightforward business. That's why they spun it off, because it will trade at a higher valuation. It will unlock value. That's why they spun it off, or else they would have just kept it in the business. So BAM will always trade at a premium to BN, because it's not a really conglomerate. It's more of an investment management business. So I believe 28 to 30 times is not expensive at all. But even with a multiple contraction, if the company delivers 18 to 20% of earnings per share growth, and I'm getting a 3% dividend, I don't see why I'm not going to get at least a 15, 16, 17, even potentially 18% annual return with a multiple contraction if I'm buying Brookfield Asset Management today. And this is another reason why I believe the company could do well in 2026, is because they pay a dividend. And if the Bank of Canada is lowering rates and the Fed is lowering rates, a lot of those dividend payers will look attractive. And BAM is a dividend payer, so I think it could attract a lot of capital in 2026. Now, the main risk of investing in Brookfield Asset Management is the whole setup with private credit or private lending. And I got a lot of questions on that, and you told me, what do you think about it? Well, for private lending, this is a major problem. And a lot of companies have been getting involved with that. And private credit in general is whenever an asset management, let's say like Blackstone, they would lend a private company, it's all private, there's no banks involved, and there's very little regulations in this market. And a lot of people compare it to whatever happened in 2007 and 2008. But for the private lending, they would lend the loan out, and Blackstone would market on their books at 100. They can market at whatever they want because it's all private. You can't really know what's going on. So the investors in Blackstone, they see that 100 and they see it's their loan portfolios are performing well because Blackstone can pretty much market at whatever they want and they're happy. Okay. But a lot of situations have been happening where those private companies, they would go under and they don't have enough assets to back the loan, but they were lending them anyway and doing a lot of crazy things to generate revenues. And some of them, they go bankrupt overnight. Whenever they go bankrupt, Blackstone marks it from 100 to 0. And it's just a terrible way of investing. But Brookfield Asset Management is not too involved in private credit and mainly in direct lending. And you can ask AI itself, it would tell you that the companies that are exposed the most are Eris Management, Blackstone, Golub Capital, Goldman Sachs Asset Management, and Apollo Global Management. And BAM themselves, they answered the question. And I said, what we're seeing across our portfolio and the broader credit trend is that these events are very isolated and not a sign of a broader credit cycle. And if you actually look at our portfolio, we don't have any relevant exposure to those issues. Our area of focus has really been heavily around real estate, asset-backed finance, opportunistic, and we've been less focused around the more commoditized part of the private credit market related, especially around direct lending. Direct lending is the one that's in trouble. BAM has been doing it for many decades. Oaktree, which is Howard Mark, pretty much founded the company and he used to own it. Now it's owned by BN and BAM. They've been doing it for many decades and they mainly focus on asset-backed financing. So if something happens, they can take the assets and sell them to back the loan. But they back it with something. It's not really backed by nothing and hopes and dreams. So I'm not really as concerned as a lot of people are around BAM's position in private credit. And the company answered it themselves and they have a good reputation and an amazing CEO. So I love BAM for 2026. I also love Amazon. And I have a few more investments. If you're interested in knowing what I'm buying, what I'm selling, I share everything in my group. This is the link if you're interested. But thank you for watching again. It was not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.